Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined by my good friend Connie Hill out there in the chat. Connie is there to help facilitate the conversation and keep that going and help to answer your questions along the way. By the way, let's talk about you for just a second because we do have a lot of new attendees today. We're welcome to all of you. We're glad to have you here with us. Whether you're here for the first time or whether you've been here, this is your 100th time being here. Either way, we're glad to have you joining us for Trading Index Options here this afternoon. If you're watching this in the recorded version, thank you for joining us in that mode as well. Leave us a comment in the comment section so that we know that you were there. And as we get into this discussion today, today is very simply a great illustration, as some of the conversations that I've been having in the chat earlier in this discussion will indicate. It is a great indication of the nature of markets and how volatile they can be because of news. And one of the more predictable, if you can call it that, predictable news events is the impact of earnings announcements on the market, maybe on an individual component of the market, but collectively, earnings season can drive market movement. So we're going to talk a little bit about that today. We're going to talk about some methods that index options could be used for in managing or perhaps hedging risk in an overall portfolio. We'll also manage our 14-day till expiration, 7-day till expiration option strategy, index option strategy as well. A couple of quick housekeeping items, though, as we get started here. Remember that everything we talk about simply for illustrative and educational purposes only. It is not any kind of recommendation or advice. Remember that past performance, no guarantee of future results. Equity and index options carry a high level of risk. They are not suitable for all investors. Make sure you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, the options that we're going to be discussing primarily in this webcast are index options and primarily European style index options. Those European style index options do not allow for early assignment, meaning they cannot be exercised prior to expiration, which eliminates that early assignment risk if you are short an option. But just a quick reminder that American style short options, which includes most equity options, can be assigned at any time up to expiration, regardless of how far in or out of the money they are. So be aware of that. Now we're going to talk about probability analysis. We're going to talk about technical analysis. All of those are theoretical. None of those are guarantees about what the market is going to do. When we talk about technical analysis, remember that it's not shouldn't be a sole means of investment research. We're also going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that. That is a great learning environment. It is not a guarantee of future success out there in the market. However, it is a good sandbox to play in. But there are some differences between paper money and live trading. Be aware that one of those is the early assignment of short options, if they're American style. Doesn't happen in a paper money account, does happen in a live account. And we'll talk a little bit about some of those other differences as we go along. So a couple of things I want to talk briefly, because I know we have a number of new attendees with us. So I want to kind of talk through why this section is focused on index options. We'll talk a little bit about what index options are, and then we'll jump into some of the examples. So let's take a look at index options kind of as a whole. Index options are options that are issued on a variety of different index products. Now, indexes are nothing more than an accounting of numbers for a particular group of stocks, for instance, like the S&P 500 or the VIX index, or say, for instance, a foreign currency index or some kind of virtual currency index or something else. So an index is simply the numbers accounting for those prices. So there's nothing that can be bought or sold in an index, but we can trade options around that index, and those indexes, because they are what are referred to as cash settled, those index options, cash settled, have some advantages. Because if we were to buy, say, for instance, a long option on the SPX, that long option, call or put, settles at the end of its expiration to either cash or zero. Cash or zero. So whereas an equity option would settle to either a long position in the stock or zero, or a short position in the stock or zero. So an index option, the ones that we're talking about, are cash settled indexes. Index options, and again, I'm not a tax advisor. I don't play a tax advisor on TV. I can direct you to some resources where if you contact our branch network, you can get in touch with some of our financial consultants that can talk a little bit more about that. But some index options may receive favorable or beneficial, in some cases, tax treatment. Additionally, there is that element that we talked about, those European style indexes that don't allow for exercise, or conversely, early assignment of short options. And so those are some of the benefits potentially of trading index options. I'll give you some resources as well to find out more about index options. But some of the strategies that we're going to use in this discussion: vertical spreads, both short and long vertical spreads. We're going to combine those vertical spreads into iron condors. We've occasionally talked about butterfly spreads, and we've talked quite a bit, and we're going to talk today about using index option strategies to hedge or manage or balance risk in a portfolio. So these are some of the things that we are going to do in this discussion. So here's what I'm going to do. I'm going to pop over to the thinkorswim desktop software platform. We're going to take a look at what's going on with the indexes today as we get started here. This is the S&P 500 index. Remember, you can't buy this index. You can't sell this index, but you can buy and sell the options on this index. So here's what's been going on with this particular index. This particular index happens. So this is following the prices of the stocks in the S&P 500. It is a cap-weighted index, which means that market capitalization, the larger the market capitalization of the component of the index, the more weight it has in the index. Some indexes are equal weight indexes, but this is a capitalization weighted or a cap weighted index. And what we're seeing right now is that over the course of the last 2 trading days, the S&P 500, while it's still in an uptrend, saw a big gap down to the downside, broke below the 50-period moving average today. In fact, just in the last few hours, turned around and went significantly higher, made a big move to the upside. The NASDAQ is, again, another index. This is the technology-heavy NASDAQ index. Broke below that 50-period moving average, rallied back up strongly today. And the Russell 2000, the small cap index. These are the 3 that we primarily will be focused on in this discussion. But that Russell 2000 index saw a downward move and a little bit of a reversal yesterday, and today, in fact, starting to break back higher here a little bit. So taking a look at this discussion and just kind of seeing what's going on with these 3 indexes. Right now, today, it's a pretty strong up day relative to what it was yesterday. One other index that I want to look at really quickly, and that is the VIX index. For those of you that might be familiar with the VIX index is the volatility index. It measures, or it gives us information about the level of volatility in the market as is indicated by options pricing in S&P 500 or SPX index options. So the VIX is sometimes used as a measurement of fear and greed in the market, or fear and complacency in the market. It's sometimes used as a measure of how volatile the market might be. It oftentimes, going into earnings season, tends to get a little bit higher just because there's greater volatility in the market. It certainly responds to things like geopolitical news. This was the tariff impact back here, that big spike earlier in the year up to the 60 mark on the VIX. Today, we've seen obviously some geopolitical news in the last few days. That has brought the VIX back up above the 20 mark. And then now with some resolution of some of that geopolitical instability news, starting to see that VIX bleed back down again. The VIX reacts pretty quickly. So this is an index that we use not only as kind of a market measure, but it is also a tradable, it has tradable options in and of itself, because there's nothing there to trade. You can't buy the VIX, you can't sell the VIX, but you can buy and sell the options on the VIX. So here's the thing about these indexes and why they are important. Because these indexes tend to be relatively diversified. So we go back to that SPX index. Let's go back to our index grid. This is representative of the movement of the 500 roughly stocks in the S&P 500. Because of that, it takes out, trading these options takes out some of that individual stock volatility that might come into play, say, for instance, around an individual stock seeing movement based on earnings. I'll give you an example, and I'm going to just pop a stock in here really quickly as an example of individual stock earnings risk, NFLX. I just posted a video on X about this. And by the way, you can follow me on X. You can follow Connie on X. My handle there is at Ben Watson CS. Connie is at Connie Hill CS. But you see the individual potential risk in an individual stock around its earnings announcement. Netflix came out with earnings, the price of the stock dropped, and the price of the stock rallied back up. So that being the case, by looking at something like the SPX, and trading an instrument that is reflective of a larger group of stocks, for instance, it mitigates out some of that individual specific event risk around an earnings announcement. However, it is still subject to changes in volatility based on earnings season. So I'm just going to put on here an indicator, the implied volatility indicator. Now, this is going to look fairly close to what we were looking at with the VIX. But one of the things that we know is that this volatility indicator, let me zip this down and we'll pop this one back up. This is the implied volatility of the S&P 500. When does the S&P 500 become more volatile? Generally going into earnings season. So think about it. January, February, March, that's one earnings season. April, May, June, that's the second quarter, that's another earnings season, and so on through the list. So when would we expect that implied volatility begins to go higher? When we start to get into earnings season. So you can see that there was a little bit of spike here in October as those companies started to report earnings. There was a little bit of an increase in implied volatility as this latest earnings season now starts to get kicked off. And so because this is, again, responsive to some of the larger components in the S&P 500, it is also responsive to their movement because of their individual earnings announcements. So if you've got individual stocks, so let's go to my monitor tab for a second here. And I've got a group of stocks here called beta weighting. We're going to talk a little bit more about that, what that means in a minute. But you can see that I've got some that have earnings announcements coming up. Amazon and Boeing and Disney and GE and Coca-Cola and Netflix. There's that Netflix earnings. That flag is still on there. But all of those have their own individual risks, but I can manage that risk or hedge against that risk by using an index option. So we could simply go out and buy a put option, say, for instance, on the SPX, and offset some of that risk that we might see in our overall portfolio. And that would be one method of using an index option to manage risk. So let's do that right now. But here's the question that we might ask, and I'm just going to pose this question to you. When I'm looking at a group of stocks like this that is diverse in nature, because I've got a bunch of stocks in here. I've got Amazon, but I've got Boeing, and I've got Conagra Foods and Delta Airlines and Newmont Mining and Coca-Cola, and then I've got some streamers in here with Disney and Netflix and Energy and Vistra and Walmart. I've got a pretty broad cross-section of stocks in different industries. How do I understand what the risk is of each one of those individual positions relative to the overall market? How do I know how fast or slow these individual stocks move relative to the market and how much risk I might have? So what I could do is I could manage the risk in each one of these by going out and buying a put option, for instance, on each one of these positions. Now, that's going to be, one, expensive. Two, it's going to subject me to a whole lot of time decay. And three, it's going to be difficult to manage just from a logistical perspective because I'm going to have different strike prices that I have to pay attention to. I'm going to have different expirations that I'm going to have to pay attention to. So one of the ways that we could go about managing the risk in a diversified portfolio or hedging risk in a diversified portfolio is to kind of convert that portfolio risk into a common element, a common denominator, if you will. So that's what we're going to do first here, is we're going to talk about beta weighting this portfolio in and hedging the risk in this portfolio. So what I've done is I've added a column to this list, and that column is titled Delta. Now, Delta in this particular case is not Delta Airlines. And if you say it 3 times, it's not a great sorority, Delta, Delta, Delta. But what it is essentially rate of change. So when I've got 300 Amazon Deltas, I've got 300 shares of Amazon. Because I know that when Amazon goes up $1, my shares gain $1. If I've got 300 shares and Amazon goes up $1, I've gained $300 in my portfolio. Likewise, if Amazon goes down $1. But that doesn't mean that Avgo or that Broadcom or Boeing or any of these others are going to move in the same rate as Amazon. So what I need to do is create a common delta or a common coefficient of movement. So what we're going to do is we're going to change all of these individual deltas into one delta, and we're going to make this that SPX delta. We're going to convert all of those individual stock deltas into SPX. I forgot the P in the middle there. SPX deltas. Now, how do we do that? We come up with what is a commonly used measurement of rate of change versus a benchmark. So we use a beta function. Beta is the Greek the Greek letter that defines the variable that calculates the coefficient of movement relative to something. And so what we're going to do is we're going to convert all of these deltas into SPX deltas, because right now they're Amazon and Broadcom and Boeing and Conagra and Delta deltas. There you go, Delta deltas. And so we're going to convert all of those to SPX deltas. The way that I do that is I use a tool that is available here on the Thinkorswim platform. This is the Thinkorswim desktop software platform, specifically the paper money version. This is a demonstration account, so it's made to look like a live account. I assure you it is not a live account. I assure you that I do not have $6 billion of buying power in my live account, much as I wish that I did. If I did, I probably wouldn't be talking. No, I would still be here talking to you because I love doing this. But here's what I'm going to do, is I'm going to change this disparate listing of deltas, because right now those are all those individual deltas. I'm going to change this to a common delta. I'm going to convert all of those deltas into SPX deltas. Now I could convert them all into Amazon deltas, or I could convert them all into Netflix deltas. That doesn't do very much for me. So I'm going to convert them into a diversified index, SPX deltas. Now, I forgot to mention, you've got to have that delta column there. How do you put that delta column on there? You come over here, you click on that gear wheel right there, and you add delta. You just type in the word delta, and you add in delta into the list of columns that you're displaying. And once you've done that, now you've got that display of information. So what I've done by beta weighting this, yeah, exactly, Ricebird. What I've done by beta weighting this to SPX data deltas is I've now converted each one of these individual deltas into a common coefficient, which means that Amazon's 300 shares, 300 Amazon deltas, is roughly the equivalent of 16 SPX deltas. Broadcom is roughly the equivalent of 22 SPX deltas. And then we've added them all up, and that's 100, roughly in this case, 100 SPX deltas. So in theoretical practice here, if the SPX were to go up a point, then our portfolio should gain $100. If the SPX were to go down a point, then theoretically our portfolio would lose $100. So how do we do this? How do we hedge off some of that risk? We use SPX options. So that's what we're going to do right now. We're going to look at a couple of different ways that we could accomplish this. So I'm going to go to the trade tab for SPX, and we're going to put in here SPX. And now we've got the option chain for, the option chain for SPX. Now, John asks the question, what does a negative delta mean? Means that it has an inverse relationship to whatever it is we're beta weighting that portfolio to. So if we've got something that's got a negative delta, if the SPX goes down, that's going to gain. If the SPX goes up, that's going to lose. That's what a negative delta is telling us in that particular scenario. So we can't buy or sell the index, but what we can do, buy and sell options on the index. So you know what I'm going to do? I'm going to go out here about 30 days or so till expiration. Remember that index options, especially for very liquid index options, these are going to have lots of different expirations. That's because institutions, retail traders may use index options as a means to hedge portfolios. And because they do that, they may hedge around event risk, and that requires some granularity. So the options exchanges have responded by listing lots of different expirations. So in this particular case, let's go out to the 20th of February. That's an option that expires on the 20th of February. You see that we've got our strike prices right down here in the middle, just like we do on an equity option chain. And here's what we're going to do. We're going to look at buying a put option on this index to hedge off some of that risk. Now you notice that this option chain has a delta column right there itself. Okay, that maybe gives you an insight, right? Because that may give us an insight into how much offset or how much reduction in risk we might gain with a particular option. So remember, we're long about 100 SPX deltas. So if we wanted to remove, for instance, 25% of that risk, if we wanted to take off 25 SPX deltas, we could buy an option that removes or has a negative 25 delta there, take off about 25 of those deltas. We could do that, but it's not going to be cheap. So we're going to buy, in this case, the 6690 strike put, which gives us the right to settle this option at 6690. Remember, these are cash settled options. So we're going to buy that put option. We're going to pay $52.30 roughly for that option per share times 100 shares. So that's going to be relatively expensive. That's going to be a hedge that's going to cost us $5,210. That's going to be an expensive hedge for 30 days, and it's going to suffer from time decay, and it's going to suffer from changes in implied volatility, just like an equity option does. But if we put that in our portfolio here in our group that says beta weighting, we're just going to put it into that particular group, and we're going to fire that order off. Now we've bought, as this order fills, if this order fills, it may fill here in just a minute. We may have to bump that a little bit because the market's moving around a little bit. But if that order fills, that's going to reduce our sensitivity to the movement of the S&P 500 by about 25 deltas. Let's go over here to our monitor tab. Let's go to our working orders. Here's that option right there. The market's moved around it while I was talking, so I'm going to cancel replace. We're going to just bump this a little bit. And I'm going to give it a little bit. I'm going to give it up to $53 a share. Click on confirm and send, read through that order, make sure that that's what I want to do. Still buying a put option in this case. And we're going to fire that order off. We bought it for $52.80, which means that we paid $5,280, paid a mile for this put option here. Now we're going to go to our monitor tab. We're going to close that working order section. And here is that SPX option minus 25 deltas. And you notice what our now total deltas are for this part of our portfolio. 75 long SPX deltas. So we've just removed 25% of the risk, theoretical risk, out of this portfolio. And we had to pay up for it. And it expires. So this isn't something that we would necessarily, or that a trader would do all the time, but a trader might do this around specific event risk. So if there's a data point coming out, say for instance, a jobs report, or there's a contentious economic summit going on in a foreign country, or there's the Jackson Hole Conference going on for the Federal Reserve, market moving events might be times to put hedges on a portfolio and remove some of that risk. Now, the other side of this coin is we removed 75% or 25% of the risk. That's to the downside. We also removed about 25% of the sensitivity to the upside. So the idea is here, if the market moves down, we're able to sell back that put option for more than we paid for it to begin with. That's what offsets our potential risk. It doesn't mean that these individual stocks won't lose money. It just means that our put option is likely to get more expensive because the market's moving down, and that gain in value may offset some of that risk. So, RB Tech Trader, and by the way, I did not ask RB Tech Trader to ask this question to move us to this next discussion, but I might as well have, because that's exactly the hypothetical question that I was going to ask to you. Why don't I use a vertical spread to reduce the cost? How could we go about reducing the impact, that $5,280 that we spent on this put option, and still get some reduction in our delta exposure? And the way that we might do that, the way that we might go about doing that is adding to this mix a short call vertical spread. Because if our expectation is that the market may move down a little bit, bringing in some premium to offset the cost of that long put option might be helpful. So we paid $5,280. I'm going to go ahead and we'll start this over again so that we can just do this as a whole. But let me kill that annotation so that you can see this. So what we're going to do now, I'm going to go to the chart here really quickly for the SPX. And I've got a resistance up here on the SPX up at about the 7,000 mark. I just want to kind of draw that line in so that I know where there's a little bit of a resistance. Maybe we've got some resistance even higher, depending on how you might do that technically. But I'm going to use that 7,000 mark kind of as a line in the sand here as a resistance level. So you could, Harry, reduce your portfolio. But think about this. If you're going to reduce your portfolio, or you're going to sell shares of stock every time that there is some sort of event risk or an unknown event risk, how do you know when to sell your shares of stock? Number one. Number two, that's selling a lot of shares of stock. So if you're going to reduce your portfolio by 25%, that might be a tough do. If you're going to use an instrument like an option to reduce your risk, that might be easier to manage. So hedging is usually not eliminating what you're trying to protect. It is using something else to protect something of value. And we're pretty good at that as rational, financially literate adults. We do that all the time. We buy protective instruments against things of value in our lives. We don't just sell them because we might lose value in them. So that's something to keep in mind. But good question to ask. So let's put this together really quickly. We're going to go back to that trade tab, and we're going to put in here another part of this discussion. So there was that portfolio that, oh, first of all, I want to close that. I want to kill that SPX option. So I'm going to do this. I'm going to just create a closing order, and I'm going to sell that one back. We'll click on confirm and send. We'll send that off and fire that off. We just close that down. So I've gotten that out of the way. Now what we're going to do is we're going to go back to that option chain. And we're going to say, all right, if we're going to buy this one for about $5,400 or $5,500, you notice that it got a little bit more expensive as we were sitting there and talking because the market was starting to move to the downside a little bit. What could we do to offset some of that cost? So we know that creating a short vertical spread on the call side is a bearish strategy. It has with it negative deltas. So here's the thing that we might do. Remember we had that 7,000 level as kind of our resistance level? So what if we were to do this? What if we were to sell, say for instance, the 7,000 call option? Now, if we were to just leave it like this and say, right, we're going to just sell a call option, kind of like a covered call, because we've got lots of shares of stock in the SPX, but we don't have an SPX position. So we can't just sell a naked call option against the SPX, because if we do that, now we've got infinite maximum loss. And generally, the broker is not going to allow us to do that, as have infinite or undefined risk in a trade like this. So how do we define the risk? Well, we first of all use this as the starting point, the short option as the starting point. We're going to bring in about 53.80, but in defining our risk in this trade, what we might do is we might go out and we might buy, say for instance, let's buy a 7,100 call option. Now, what we've defined our risk, I mean, this is a fairly wide spread. This is a 100-point wide spread. So if this starts to go up, there is the potential. If this were to go all the way up to 7,100, the SPX were, our max theoretical loss in this spread is pretty large. But we're using that as a means to help define our risk in the trade. So here's our short, whoops, I didn't want to sell that one. Let me put this order together again. So we're going to go to the 7,000, and I'm holding my control key down. We're going to sell the 7,000 strike, and then we're going to buy the 7,100. Here's our vertical spread now. We're bringing in $31 per share times 100 shares. In this case, we're bringing in $31.60. Our max theoretical loss in this case, if the index were to go all the way to 68.40, or excuse me, all the way to $7,100 on the index, our max theoretical loss would be about 600 or 6,840, which was about what our max loss was on that long put option. So that's the first part of this trade that we're putting together here. But what we're going to do is I'm going to edit this because that only gives us a little bit of reduction in our delta sensitivity. So let's think about what our reduction in delta sensitivity is here. The 7,000 put option has 35 cents of delta, and we've sell that. That's going to be reducing 35 deltas out of that portfolio. But we're going long 19 deltas. So if we come over here to our calculator, and I'm going to use our calculator for just a second, just so that if anybody is afraid of calculators, whoops, I don't want to detach that. Here's what we're going to do. I'm just going to switch my gadget. We're going to put on the calculator here. So what I'm going to do is I'm going to take 35 deltas and subtract from it 19 deltas. And that's going to be leaving us with about 16 deltas. So the delta reduction is less than if we were to just buy the put option, but we're getting paid for it. So we could just do it that way. But I think there's something maybe we could do that's a little bit better here. What we could also do is at the same time, we could come out here, and if we're going to try to reduce, so if we're left with about 16 deltas, then what if we were to just come out here and buy a less expensive option? Let's say we were to buy an option here at about let's go to the 6,600 delta. That's about 20 negative deltas. And if we were to do that and buy that one, you notice what we're doing here? We're creating this protection in this portfolio. We're reducing our net deltas in this portfolio by about our 35 deltas here. And we're doing it actually, in fact, not for a debit. We're not paying for it. We're actually getting paid to do this. Oh, okay. That's cool. And we're going to do this over the course of about a month. So we could simply let this hedge run itself out. Because remember, can't be exercised early. So by doing this, we're putting together a hedging position that reduces some of our portfolio risk. Let me show you what this is going to look like. I'm going to right click and I'm going to put this over on the Analyze tab. I'm going to take some of these other positions off here. Let me kind of bring this up a little bit so that we can see these. I was building this earlier, but here's our position that we've now created. We don't own shares of the SPX because remember, the SPX is a cash settled index. There are no shares to be bought or sold. But what we can do is we can create this combination. Now, I've heard sometimes this combination, which is a short call vertical spread and a long put, I've heard this sometimes referred to as a seagull spread. If you've got iron condors, then sometimes this is called a seagull spread. I just heard this the other day. I didn't know that. So that was kind of news to me. But right now, where this is sitting right now, we look at this Analyze tab and we see that this position or this hypothetical removes about 35 deltas from our portfolio, and we're getting paid for it. So we're getting a little bit more protection and we're getting paid for it. Now, what happens is if the market goes way down, that's where we start to pick up some gain. If the market goes way up above that 7,100, our risk is limited. But remember, we've got at this particular point, hypothetically, the potential risk is to the downside. We wanted to remove some of that earnings season risk out of the portfolio. So by doing something like this, by creating this combination of a short call vertical spread and a long put, we're reducing about 35 cents of delta or 35 deltas out of our portfolio, and we're doing it for a credit. So let's bring that up. Let's fire this order off. We'll see if we get filled on this order. We'll put this in our beta waiting group and we'll click on send. Now, part of the problem might be because these are a little bit further out of the money. There may be less liquidity in these options, maybe a little bit harder to get them filled. But we got this combination filled. We brought in $5.50 for it. If we go over to our monitor tab, now you can see that we reduced about 35 deltas out of this portfolio, and we did it for a credit. Now, DGen asks the question, could you use something like an ETF option? Yes, you could, but ETF options are in this case, are European or American style, so they could be assigned early. So you have that early assignment risk if you were going to use something like that. Now, there are other instruments that we could beta weight this to. There is XSP, which is a smaller version of the S&P 500 index, and we could beta weight this to that index. Those costs for those options are a little bit smaller. So that's something that is potentially beneficial to be able to do. So what we've done is we've used a means to reduce one example of how we could reduce SPX risk out of our portfolio. Now, iShane's asked the question, what sort of rate of return is possible on the current trade? Well, the answer is this. The rate of return is not looking for this trade itself, this combination trade to generate a return. The rate of return comes in the fact that you've reduced risk. We're not trying to win with this hedge. We're trying to reduce risk with this hedge. This is not a, hey, we're going to go out and get a home run with this trade. We're not gonna try to annualize this because this is a circumstantial and individual specific discrete event that we're using this for, an earnings season. So this type of trade, putting together this type of hedging trade that we built here, we're not trying to gain a return on it. We're trying to use it as a means to offset risk in our larger portfolio. Now that differs from the other strategy that we talk about on a fairly regular basis. I'm going to have to do this relatively quickly because, whoops, I don't want to go there. I want to go right here. Hang on to our index options grid. I'm going to have to do this relatively quickly because we're running out of time. But this is our SPX 14-day, 7-day strategy. And one of the things that we can do here with this strategy is we can use this as a means to generate income on a weekly basis again and again and again. So we know that our next expiration is the 4th of February. So we're going to go out to the chart and we're going to move our line out here to the 4th of February. So what we're going to do is we're going to sell in this strategy every 7 days. Basically what this strategy does is it sells another short vertical spread, and then 7 days later it buys it back. So we're going to go to the monitor tab, and I'm going to take a look at this section. And I've talked a lot about this on a regular basis. So here's our SPX vertical spread. We sold it last week for $2.10. It's now trading at about $2. It's bouncing between $1.90 and $2. 7 days to go until expiration. We're going to close this down at basically a push because the market volatility has increased. The market went down a little bit. So I'm going to click on confirm and send. We're going to close this down. Now, could you leave this till expiration? Yes, you could. In the way that we've done this and set this up, we're selling at 14 days, buying back at 7 to capture rapid time decay in the beginning portion of this trade. That's why we're buying back at 7 and closing this trade down. So we're going to buy that back, close that part of the trade down. We bought it back for $2. We made 10 cents on the trade. Not a lot, but that's a rarity. It's better than taking a loss on the trade. All right. So now what we're going to do is we're going to go back to that chart and we're going to say, all right, where is this strike price where our date intersects with the 1 standard deviation line? And I'm seeing that right about 66.55. Right about there, 66.55. So we're going to go to the trade tab at 66.50, and we're going to go out to the 4 February expiration, and we're going to sell a put spread. Now, why are we selling a put spread? Because the market's still going up. So we're using that directionality to take advantage of this. So 66.55. Do we have a 66.55? We don't. So I'm going to go to the closest one, the 66.50. Actually, let's go to the 66.60. I'm going into the 66.60. 16-cent delta. High probability this is going to be out of the money. So we're going to sell the 66.60. And at the same time, we're going to buy a 20-point wide vertical, or excuse me, we're going to buy an option that is 20 points further out of the money. This is going to be a 20-point wide vertical spread. So 60 to 40 is 20 points. We're going to get 205 in credit for this. We're going to click on confirm and send. We're going to put this in the index options weekly group. And the idea is that generally we're going to collect some of this premium. Not all of it. We're probably not going to get $2.10. But we're also very likely to not take that max theoretical loss. We have on a couple of occasions, but this is a high probability trade. And we just do this week after week. Now, one of the other things that maybe some of you have noticed, and I just wanted to quickly remind you of, is that look at all these different expirations. You don't just have to do this on Wednesday. You can have a vertical spread on Tuesday and take it off the next Tuesday. You could have a vertical spread on Wednesday and take it off the next Wednesday, and one on Thursday and take it off the next Thursday. So you could ladder this so that you've always got one that you're taking off and always one that you're putting on. And that's something that index options are beneficial for in terms of that liquidity. If you want to learn more about index options, this is a third-party provider of information. This is Chicago Board of Options Exchange, or Cboe Global. They are generally the provider of index options, the exchange that handles those index options. So if you want to find out more, Cboe.com, and go to retail, and you're going to see information about index options. They are a third-party provider, so all of the information that they provide is coming from a third party. It is not the opinion or the recommended by or anything else by Charles Schwab. If you want to learn more about that, about the strategy or vertical spreads, come on over here to the Trader Talks webcast page. When you do that, click on the subscribe button, type in the word index or condor or vertical. You're going to see lots of different webcasts that talk about those particular strategies. And then come over here to schwab.com/coaching. If you want to meet the coaches, you want to know who's teaching these webcasts, join us right here. Find out what we do and what we think and who we are right here on the schwab.com/coaching page. That's some great stuff. My thanks to Connie Hill for helping out. And my thanks to all of you. Remember to click on follow. Remember to click on like. And we will see you guys again next week. Love to have you all come back. We'll see you then. Take care, everybody. Bye-bye.